Neupath is a leading provider of medical services targeting chronic pain, musculoskeletal injuries, and sports injury care. The company just released strong Q2 financial results with revenue growing 25% and adjusted EBITDA up 69%. We're fortunate to have many members of the senior management team here joining us today. We've got CEO Joe Walewicz, CFO Jeff Zygouras, and President Stephen Lemiux. And they're all here to present and review and take questions from the audience. I'm Martin Gagel with Market Radius Research. Please remember this is neither recommendation nor investment advice. We're here to learn about the company. Gentlemen, thank you very much for joining us. How are things going?
Great. Thanks, Martin. And thanks. I think we're now on our third call together, at least. So thanks to everyone for joining us as well on audio. I think a little different from previous quarters. First and foremost, as Martin mentioned, I brought my CFO Jeff Zygouras with me, as well as Stephen Lemieux, our new president. And instead of really kind of going through what is Neupath all about, we'll give a brief intro to who we are, but also just try and provide a little more update on what's happening right now at the company and our expectations over the near term. So with that, I think we'll go straight into the deck. So I'll start moving slides around. So this is an investor update. So we will make forward-looking statements, and I advise you to have a look at our annual information form that was filed in March of this year for any risks and uncertainties that we may have in terms of our forward-looking statements. We will refer to some non-IFRS measures, so I want to highlight that for you, and you can have a look at our deck as well as in our financial statements for additional details on those. So let me tell you about Neupath just quickly. Reminder once again for those of you who've seen it or those who are new to the story, we are a private provider of public health operating a growing network of chronic pain treatment facilities. I think for everyone here, I think we all know this is a large and growing market. It's unfortunate, but we all know somebody who suffers from chronic pain. There's probably many of you on the call who are suffering from various musculoskeletal and long-term pain. So this is a market that we serve in Ontario and Alberta right now. We have lots of opportunities to grow this business. There's lots of people who need care and are not getting it. We think that we can help by adding to our footprint. We also want to just highlight these are regulated facilities. So what we do is not a normal doctor office. So when you look at some other clinic consolidators, they're really running, a GP office is very different than a specialized medical treatment facility like what we do in our locations. We are well positioned for changing health policy. We've talked about this in the past briefly. Basically, things that used to be done in hospital are now being done in the community. We think that's great medical care, and we're happy to be part of that, whether it's cataract surgery, whether it's things like what we do in terms of interventional pain medicine. Those things are generally, you're seeing that moving out of the hospital, even some low risk surgery. You're seeing a lot of governments talking about that. So we see us as part of that evolution of the Canadian system, which is a fair bit behind other medical systems in terms of that. We've really, there's been a real successful turnaround here. And I think, I can't say enough about, Q2 really being an emphatic exclamation point on that. We spent a long time and a lot of sweat, Jeff and I, and now Stephen, trying to get this business to where we wanted it to be. And we're not, I want to say we're not there yet, but we're very pleased with how things have been going. So as a reminder, I think, we operate clinic and non-clinic businesses. So I'll spend most of my time talking about the clinics business. But we are currently in Ontario and Alberta. And as you can see in Ontario, we're Ottawa to Windsor and almost everywhere in between. In Alberta, we're in Edmonton and in Red Deer. And of course, thinking about other locations in both of those provinces, as well as entering new markets. So this is kind of where we're at today. We operate under three brands on our clinics business. We also have a small minority stake in some physio and sports medicine locations in Edmonton. And with that, I just pass it over to Jeff. We'll give you a quick overview, kind of our financial results and highlights in addition to what you've seen with our filings last week.
Thank you, Joe. Good morning, everybody. Thank you, Martin, for inviting us to be with you here today for this webcast. So turning to our financial results as of June 30th, 2025, revenue for the first half of 2025 reached $43 million, which represents an increase of 18% compared to the same period last year. This growth reflects our improved capacity utilization, the strong early demand we're seeing for our Zygouras, and the continued optimization of our clinic footprint, and we expect this momentum will continue. In terms of profitability, Adjusted EBITDA for the first half was $3.5 million, which is up 61% from last year. In the second quarter alone, Adjusted EBITDA grew 69% year over year, up to $2.2 million, and marked our 26th consecutive quarter of positive Adjusted EBITDA. Even excluding the one-time benefit from physician reimbursement adjustments, we still delivered over 30% growth, which speaks to the strength of our business and our team's ability to mitigate cost pressure while improving efficiency. Gross margin held steady at just under 20%. Sorry for the background noise. Supported by both reimbursement adjustments and stronger revenues from fluoroscopy. This consistency reinforces that our growth is not just top line, but also translating into healthy operating performance. Turning to the balance sheet, we ended Q2 with $3.8 million in cash and net debt of $2.7 million, down nearly 50% from fiscal 2022 when Joe and I took over. With this strong cash position and access to additional borrowing capacity through our national bank financing, we have flexibility to continue investing in growth initiatives, including technology and transactions, while maintaining financial discipline. Overall, we're quite pleased with the results to date, and we continue to believe we are well positioned for growth and value creation for the second half of 2025 and beyond. Back over to you.
Okay, thank you, Jeff. So I'm going to pass it over to Stephen, who's just joined us as president in April. Actually, I should say rejoined. Stephen was previously the CFO of the company when we did our RTO in 2020, prior to that, and then did the RTO, and then went on to some NASDAQ-listed companies. We brought him back really to help on the growth strategy and to help execute on that. So I'll pass it over to you, Stephen.
Perfect. Thanks, Joe. Thanks, Martin, for hosting us. I'm excited to be back with the team, and I think that where I'm really focusing here is kind of the next stage of the business and growth. And as you can see here, Jeff and Joe have done a great job on really stage one, right? This is increasing capacity because they can grow the business through bringing new doctors on board, improving capacity utilization, and adding new services such as arthrosamid that was added this year. Where I'm really going to focus is on the second and third piece of the growth strategy. So we're really looking to continue to build the footprint out across Canada, which means targeting areas of Ontario, Alberta, BC, and the other provinces where we're not located. Continue to look at partnerships similar to what we have in Red Deer, Alberta, which has been very successful for us today, where we partner with a group of orthopedic surgeons. And then also looking at different verticals and different services that we can add to enhance our service offering to the patients in the community and try to meet the needs of all the different patients that are out there. One of the keys with onboarding new physicians is this is a very fragmented market. There's a lot of physicians that run smaller clinics. One of the keys you talk to a lot of these physicians is that not only are they practicing medicine, but they're also on the business side, right? So they're doing HR, managing supply channels, managing their staff, managing the regulatory environment. And this is where what Neupath offers really helps these physicians. So we've got all of our all of our facilities are regulated centers. So we deal with the regulatory bodies in Alberta and Ontario. As Jeff mentioned, we're doing a lot to invest in new technology. So like artificial intelligence, always focused on improving the physician experience. So like helping them with charting, helping them with their patient flow. And then we've also got a strong referral network. We've got waitlists at a number of our clinics so the new doctor come in can step into a practice as opposed to taking time to build one. We handle all the back office administration, so everything from like finance, HR, IT, billing, managing EMR and software. So the physician, when they join us, can really focus on practicing medicine and less on the business side. And with our multiple locations, we can really be flexible on where physicians want to work. And we can also be flexible on the work days that they want to work with us as well, as some physicians still work in their own practices or work in ERs and then work a few days for us. So one thing the team's done well, and Joe's highlighted this before, is we've really right-sized the footprint of the business. So we have a lot of clinics that were either too large or inefficient. So we've done a good job in Ontario. We've updated all the facilities, brought in new technologies, right-sized the footprint, and even looked at new locations where we can maximize the flow to try to get a consistent volume of patients through the clinic to try to treat everyone that's sitting on our wait list.
And I just wanted to add one quick item here is that although we have been shrinking our footprint, we expect to finish this year, obviously, at a reduction versus where we were 2 years ago. We are starting to expand some locations. So this year, although we're shrinking 1 or 2 locations in 2025, we've added to our larger, faster growing locations. So, I think this is kind of where 2025 is where you see that plateau. And then, kind of from a footprint point of view, we've done the right sizing that we need to, and hence focusing on other areas.
As I mentioned, so our throat submit's a new product launch for us. So these are some opportunities we're looking for. So this is a cash pay procedure. It's a real novel treatment for anyone suffering from OA of the knee. And it's just a contour product. So we've launched this in Ontario and in Alberta now. And we're the largest deliverer of this in the Canadian marketplace. And we continue to grow and see a lot of interest from both the Canadian marketplace and the US marketplace. And then on the inorganic side, so this is where I've really been focusing. So with Jeff and Joe mentioned, with the turnaround of the business, the improved balance sheet, the strong cash position, and the support we get from National Bank, we're really in a great position to start looking for tuck-in acquisitions, look at new geographies, improving our facilities. So we're looking at opportunities like both in Ontario and out west. We're talking to a number of physicians for partnerships on new growths or new clinics. And then we're also looking at new therapeutic treatments similar to our Throsamid that we can bring in and offer to our patients, as well as adjacent verticals where we've got overlaps in patients or areas where we can work with different physicians with our regulated facilities and offer good level of care to people out of the hospital and more in the community.
Yeah, and just, to think about adjacent verticals just briefly, logical would be anything from orthopedics to radiology. Those would be the kinds of, or sports medicine, those kind of things fit in with what we do. And, it certainly would be what I would call the adjacent verticals.
With that, I'll pass it back to Joe.
Yeah, sure. So I think one thing that, I want to just highlight over and over again with investors is it's a very tight cap structure here. We've got 34% is institutional ownership. We've got Bloom Burton that includes Bloom Burton, who's on the board and a big shareholder of ours. We have Claret Investment Management in Montreal owns over 10% of the company. And since then, myself, Jeff, and Stephen have been buying in the market. We also decided to launch a NCIB as well last Q4, and we've now repurchased 723,000 shares as of July 30th. So, we're continue to invest in the business. We think it's undervalued. As you can see, we got a 15.5 million market cap as of yesterday, trailing 12 months, about 5 million in adjusted EBITDA with net debt of, less than 3 million. So we think we're in a extremely undervalued situation. We're going to continue to act on that in the market. You can see on the right, it's pretty clean now. When we did our RTO back in 2020, we had a number of different warrant structures. We had related party debt. All of these things have been cleaned up, and so we're really, you basically got this one set of warrants that expires in January of next year, so 26. They're at 25 cents, and just to be clear, that's Bloom Burton. So as an insider, they're very supportive, and we wouldn't expect anything surprising there out of those warrants. So I think just to provide you some quick outlook, because we don't provide guidance, but certainly wanted to keep letting people know where we think the business is performing and how we expect it to perform. We expect continued high single, low double-digit organic growth for the base business. So this is talking top line growth. That's where we think it'll be. I've talked many times in the past about adjusted EBITDA margins, where I thought our target for a business of our size, about 8 to 10%, would be reasonable. And as we grow the business beyond, the 80 million run rate that we have today, we have opportunities to expand that margin. So that 8 to 10% is where we continue to track to. I can say that, you saw the numbers for the first half of the year. I can say that excluding, one-time adjustments, we were over 7% in Q2 and approaching 7% Q1. So you can see the continued progress on the business, and we're continuing to progress towards our 8 to 10 goal. Um, Finally, just on the inorganic growth at transactions, as Stephen mentioned, we're evaluating multiple opportunities at present that we can execute on. We expect, we're very comfortable we can execute on one or two over the next 12 months, and we'll keep you posted as to what those look like. Obviously, timing and size of these are very difficult to predict, when you have a bunch of balls in the air, but we're very excited about both the team we have, Jeff and Stephen, looking at these, as well as our operations team looking at these, and as well just now having the capital in place and with the National Bank to help support some of these initiatives. Um, finally, just there's our IFRS numbers, which I'll kind of leave there for you, and you can see that in our financials that we filed last week. And then I'll just say thank you, maybe turn it over to you, Martin, if you have any questions for us.
All right. Thank you. That was good review. I guess starting at the top of your income statement, you had very strong revenue growth, up 25%. Could you dissect that a little bit, where that revenue growth come from? You obviously get better utilization rate in there. Are you getting more ancillary services, or what's the 25% is pretty significant growth given that your footprint didn't increase by 20%, 25%. How are you managing that?
Sure. So I think, just to be clear, I think we'd said, both with our Q1 and Q2, we had expected a material one-time retroactive adjustment in Q2. So we saw that there. And
Okay.
if you take that out, you're looking at that high single, low double digit, which is what we've been delivering for a number of quarters now. And so that's being delivered by, doctor hours. It's being changes in reimbursement rates. It's being more patients coming in. Q2, we had a nice pickup there. So it's really, but that all is driven by doctor hours. So as we have more physicians adding time at our facilities, then we start to see those revenues pick up. So that's it. And then additionally, we mentioned arthrosamid. That's a very expensive procedure, so that starts driving. We had added fluoroscopy capacity in Q4 of last year, both out west and in Ontario. So in Ontario, like, we added 2 new fluoroscopy suites in May. They only started, so that we added them last year, but we only started treating patients at the beginning of May. So that's really new. Both of those facilities are kind of adding to the growth. So we've got higher value procedures, both from arthrosamid and fluoro. We have physicians adding hours and taking on new patients. We have reimbursement rates. So all of those kind of mixed together are giving us that good organic growth. And now with the balance sheet where it is, we're looking at inorganic opportunities.
All right. I presume internally you track the total physician hours. I'm guessing it's not presented here, so you can't get too granular on that. But that is clearly growing and expanding. And is that one of your sort of key internal operational measurements?
Yeah, so internally we look at, number of doctors, doctor hours, patients seen per doctor hour, kind of all these kind of classic things that you'd expect to look at. I think in terms of physician hours, I think that we had mentioned in the past that, last year, I think in Q1 and Q2, we had some departures. And what we've seen happen is that other physicians have filled in those hours. And so the net impact, for example, at the one clinic where we had a number of departures, we're actually seeing more patients now than we did a year ago. So even though there are some departures, so you kind of see how doctor hours, ultimately we're able to treat patients with doctor hours. And so it's number of doctors and the amount of hours they're offering to you and filling up their schedule in the day. If a doctor's sitting around for half an hour because the patient canceled, that's a lost opportunity for them, for the patients, and for us. So, we kind of manage all of those pieces at once. I don't know, Stephen or Jeff, if you had anything to add there.
No, I think just to tie in, right? Like part of the growth strategy is like expanding doctor hours for the doctors we currently have. And as Joe mentioned earlier, like, we are expanding a few facilities in some of our busier markets. So by expanding the footprint, like, we've got doctors there that will be adding days to build their practices out to fill that footprint that we're looking at. So that's one of the keys we look at when we expand a current facility is, can we add more treatment rooms? Will doctors add days? And we're going to be seeing that in a couple of our clinics as we go through the rest of this fiscal year.
Yeah, and I think just to add to that, Martin, I had talked in the past about capacity utilization. I think at maybe one of the Bloom Burton conference, where people talk about this whole idea of where I want to go with this is that if I, in theory, as a flow time, money engineer, you might look at this as 100% as your ideal. The problem is from a recruiting perspective, if you're at 100%, you can't add new people. And so we're never going to hit 100%. And so at clinics where we have, and those are the two that we're expanding right now, where we've really kind of bumped up against capacity, by adding those extra space, the other doctors are adding hours, or doctors who aren't in those clinics who want to work in that busy clinic are adding hours there. So it's kind of how we can, we're now at the point where that the wrong sized footprint that we had is now right sized, and now we actually in a few locations we're going to have to add a little space. And sometimes it's a little bit confusing as well. For example, we'll have a space that's say 4,000 square feet, and one of the rooms is a storage room. And we'll say, well, geez, we're really busy. Let's convert that to a treatment room. So from a square foot percentage, you don't see any change on our end, right? Like as an investor. But on our side, we see another treatment room, and then that allows us to add some time. So there's little. It's a very complex piece underneath in terms of how we look at that. That piece. Like I have a doctor who has family commitments and works 10 to 4 every day. I have about Monday to Friday. I have another doctor who works 7 to 7 Monday to Wednesday, right? So there's different ways to look at this.
And I guess even just the utilization rate, there are so many ways you could slice that because you're not operating 24/7, or would you ever do that? So their hours, and anyways, it's a complicated metric, I can imagine, on what gets added in and out of that.
Yes, yes.
Could you talk about the physician market in general, adding doctors? Is the market becoming more competitive, or because of the stress we hear about doctors being faced with on a regular basis, having a well-run, organized clinic, are more doctors knocking on your door asking for opportunities there?
Yeah, so I'd say that our entire healthcare system and most healthcare systems around the world have a shortage of doctors, and so that's not new or recent for us. So we've always faced that problem. I think what we're trying to do is offer a great environment for physicians where they can come in and be very efficient. Come in. First of all, our locations are in the community where they live. They don't have to get stuck 2 hours on the Don Valley in Toronto trying to get to a clinic or to a hospital downtown. They can drive to locally to a clinic where they can easily treat patients. So they spend less time stuck in traffic. They get to the office and it's efficient. You go to a hospital and you're competing for time in the treatment rooms with other specialties. At a big hospital, you might have a urologist that needs to use the room. You might have someone else who needs to use that room that a specialist could use for pain treatment. So there's definitely, by providing efficiency, like good equipment, good staff, good working hours, good locations, we think that's a very competitive offering. And so we're excited about the pipeline of doctors that are calling us and asking us about our working in our facilities.
All right. There's an audience question here. We have discussed capacity utilization, but I just want to make sure this is addressed. Why has capacity utilization been constantly increasing, and how are you going to manage it? I think you've largely covered it, but anything to add?
Yeah, I think that that's a good question that they asked about that, and I think that you've seen first and foremost you've seen the shrinking of the footprint, right? That's happened, and so that's been a big part of that, and as well just having doctors adding hours and days, right? So those two pieces there. If you have people adding hours and you shrink unused footprint, and I want to be clear when we're shrinking footprint, it wasn't like we had all these empty clinics. We had a number of spaces that were unused. For example, our head office and Mississauga clinic were 17,000 square feet. We now have the same offering in 6,000 square feet, and not one person would say you shrunk, right? From a patient or a physician point of view, it's actually a very nice facility. It's just the way it was configured and used and subleased and all these things. So we had in London, we had 15,000 square feet. We're now 7.5. The 7.5 that we gave back to the landlord was being used by family doctors that we subleased. So we didn't lose any treatment rooms for our physicians. So that's how the capacity utilization has helped revenue growth, shrinking footprint. That's how you get there. It's going to be harder and harder to get over the number we're at now as we move forward. And more importantly, I don't think we ever want to be at that 100% because we're going to turn doctors away who want to join us.
All right, a couple of questions here on the arthrosamida. I'm sorry, I'm pronouncing that incorrectly. Arthrosamide.
Yeah.
Um, Roughly what percentage of locations had been offering that in Q2, and what was the incremental revenue roughly that contributed?
So let me start with the number of locations. So we started out in March with 2 locations with Brampton, Mississauga. We've since then rolled it out to a number of other locations. We're now Oshawa, Hamilton, London, and Edmonton, right? So those are all the sites right now. And I think, oh, Scarborough I missed. So that's the one. So we've added those locations that are providing arthrosamid. And so the ones that are missing, we're not at the ones I didn't mention there are the ones that don't yet have it. We have doctors at each location who are looking at it. There's a timeline for a doctor to kind of say, hey, this is interesting. Hey, can you send someone to, tell me more about this? Hey, I'm gonna, do some online training and then, hey, I'm gonna start doing the procedure. So it takes a little bit of time there. And so I think you'll start seeing other locations ramp up. So that's one, that's the locations, and then incremental revenue. So one of the things I talk about incremental revenue on this is that if I have a doctor doing arthrosamid, they're not doing a pain injection for something else. So, it's not yet clear that doctors are adding hours to do arthrosamid. So I would say that it's not so much incremental as it's changing our product mix for now. And so that's kind of the best way. Until we see more, it's very early. We've probably done under 100 procedures year to date. And so before I start providing any sort of guidance on that, we'll have to see kind of how that impacts the practice profile. But for now, I'm looking at it as kind of a net. What you see in my growth numbers, you might see a little bit from arthrosamid because it's a higher price procedure, but it's not driving the growth that we're seeing to date.
Arthrosamid, that is more of a permanent or a longer term treatment. So what you're saying is if somebody gets that patient, the doctor then may not see that patient as much in the future and have let's say, an offsetting impact. Is that what I'm?
Well, I guess in theory, I mean, it is for, so arthrosamid, and I recommend anyone, I saw some questions in the queue asking about arthrosamid. You can go to their website. It's not our product. We are a provider of a product that's licensed, that's approved in Canada by Contura. So if you can go to arthrosamid Contura, you can find out more about all the product details for those of you who have questions about that. But it's indicated for osteoarthritis of the knee, all right? And so first and foremost, our treatments across our clinic network can be migraine, they can be chronic lower back pain, they can be sciatica, they could be fibromyalgia, there could be a whole bunch of different things that patients are coming in for. So I would say that just pure knee injections, this is not necessarily taking away from what we do. The other thing is that some of these patients are here for other treatments with us, and then they go, hey, wait, what's this? And so it's actually, I don't see it as cannibalizing anything else that we're doing, I guess is the best way to answer. We see it as a new treatment for people who either haven't been getting treatment for this or may have been getting something else, but we don't see it necessarily as cannibalization. Two, as I mentioned a couple times on multiple calls, we have many long wait lists at a number of clinics. So I mean, if we can take care of some people, I think that's a great outcome. We've had certainly some great outcomes for patients on the arthrosamid to date, but it's very early days.
All right. And I know you've mentioned it before, but there's a question here. Remind us, what is the cost of the procedure? And that is all out of pocket. That's not government or maybe private insurance paid, but that's not a government paid procedure. That's out of pocket.
That's correct. I don't have the exact number in front of me. Stephen, do you have that? What we're
I think it's just over 4,000 an injection. So it's like, so if someone comes in for one knee, it's around just over 4. If they do both knees, it'd be just over 8. That's right, yeah.
And just to be clear, there's so it is private pay, right? And but what it does for the patient, just to be clear, is for people who are looking at this, it is a potential delay, or it may potentially delay or eliminate the need for knee replacement surgery, which, as you can imagine, with people sitting on long wait lists in Canada right now for those procedures, this could be very attractive for people like that. That are in that position where they're waiting on a wait list. So definitely a lot of interest from people who are on those wait lists. Also, just to be clear, it's not approved in the US, so we have got a lot of interest from people south of the border who are inquiring about the procedure, and we've had some people come up to Canada to get it done. So it is private pay for now. I don't know if it'll ever be covered by the government. That's up to Contura and their marketing team. I can't comment on that. If it's ever public pay, we'll more than happy offer that whomever is paying for it. And one last point on that, we're a little over 50% of the arthrosomid treatments in Canada year to date. So, there are other clinics that do provide it.
How much of your revenues come out of other private pay services or private insurance like physio or massage? I know you have some exposure to that. How much is that right now? And is that a material focus of potential growth opportunities, either organic or inorganic, or is your focus more on physician services?
Yeah, so I think that private pay and public pay, just to be clear, in Canada, every jurisdiction has different regulations. So we're obviously, I cannot offer anything privately that the government is reimbursing. So, we tend to, our revenues are over 95% paid for by Alberta Health or OHIP. So if it's private pay or something that's cash pay, it has to be not covered by the government. And so that's why you see something there, arthrosomid, that is not, if the government doesn't cover it, then we'll provide it for those who are interested and willing to pay. For those, we have other services that for patients who don't want that or can't afford that. That's sort of until the government offers to pay for that, we can't do anything. And so things like PRP injections, prolotherapy, some of these other items are also private pay because the government won't pay for them. There's some things like psychiatric pieces that you could add, nutrition, all these things you could add, but we really don't provide that very much, as you can see from our revenues and what I described there. I think that over time, if some of these things get added to government reimbursement, we can add that, or to the extent that patients are willing to pay out of pocket. It's as you know, in Canada, there's a real small private market.
All right. Question here, can you elaborate on your plans to expand the business into other provinces?
Yeah. Well, I can't provide details on what we're doing there, obviously, but I would say that, other provinces that are the highest priority for us, we think BC is a great market, certainly poking around here in Quebec where I live, and, starting to think about some of those would be the larger ones that we're not in. And then, of course, we've beyond that, we've looked at some opportunities in other provinces as well, but, pretty early stage. Those would be the two where we're most interested and probably most advanced looking at opportunities in BC.
When you talk about BC being a good market, what makes a good market? Is it the ratio of let's say of the backlog patients to doctors, or the availability of doctors, just the size of the market? What makes for a good market?
Those are all good questions. I mean, all of those are pieces of it. BC obviously is a larger market. Second is the reimbursement environment, either, willingness to pay privately, ability to do these things, or, reimbursement rates, licensing. There's a problem, different provinces have different registration requirements. So in BC, you cannot get a license. So if you have one, there are no new ones being offered. But if you have one, you can use that license to expand and grow. So there's different, whereas in Alberta, I could open a clinic in Calgary tomorrow if I wanted, for example. In BC, I couldn't open a clinic tomorrow in BC without getting a license. And so, there's a bit of BC would be a little more like the I guess to put it, a cellular bandwidth kind of situation where you're trying to buy that piece there. And so there's just different markets of different, in Quebec, there's a very well-established private pay market that you could do something a little differently. So, that's kind of, each market is subtly different, but at the end of the day, what we're trying to do is find great doctors who see the vision for providing, pain care to patients, and that we can partner with. And so I think that's kind of the best way to look at it. Is it's really about getting involved with the right people in the right location.
I don't know if we're taking this off topic with my question, but BC limits the number of clinics there are. Is that to keep sort of economies of scale in there? Or I know that seems peculiar to me. I've never heard of that, and you don't have to go into it too deep if it's really not that relevant. Sorry.
No, and just to simplify it, I'd just say just to remind everyone is that what we do in our clinics, all these procedures are likely available at the hospital in your community. Like
Okay.
it's just that what the difference is that because the supply or availability of those doctor time in those facilities is not there. And so if you go to say UHN downtown Toronto, they have a 3-year wait list from what I've heard, and University of Ottawa, there's a big wait list there. And so there's wait lists everywhere. And so what we provide in the clinic, what we provide is regulated facilities that provide almost the same sort of, and that's why I always say they're regulated treatment facilities. They look a lot like what you'd see, the kind of equipment in the treatment rooms you'd see in a hospital setting. And so that's kind of where these licensing pieces come in. Is it just depends on the province's um, regulatory environment for being able to open new clinics and provide new. And so in BC, they've made a decision they didn't want to allow any more
Okay.
new licenses out there. They may change that in the future.
All right. All right. What was the size of the material one-time payment related to reimbursement adjustments from the audience?
Yeah, so I think you can see from all our disclosures that we've not been disclosing the exact amount of that. But I think what we have said is that the growth rate that you saw that in Q1, is kind of a normalized top line growth rate. And I mentioned during my conversation that our adjusted EBITDA margin, excluding the one time, would be over 7% in the quarter.
Okay.
That should
All right.
and I think that gives enough people kind of what the normal run rate of the business looks like.
All right. Does Neupath have a timeline or roadmap for achieving net income profitability? And what key milestones should investors or stakeholders expect along the way to achieve that, I guess?
Okay, so in terms of the net income, I think we've reported net income year to date, and I think that in terms of, the roadmap for that, I mean, obviously we see continued improvement in the business, so we'll continue to show improvements there. In terms of net income, we also have an extraordinary amount of one-time items this year. For example, legal expenses related to closing our financing transaction. We're not going to do a new national bank debt deal every year. So there are some one-time items related to 2025 that would also put a damper on the net income versus the adjusted cash flow type number that we would be mostly referring to.
And another audience question referring back to capacity utilization. Do you think we can see capacity utilization above 90% in the near term? And should we expect less growth from the business as a result?
So I would guess I would say no and no would be my expectation that, that we're not going to see it get above 90%. We still have, we just expanded now in 2 locations. We've added, floor capacity in the last 6, 12 months. So I think we're going to take some time to fill up those spaces. So I'm not worried about growth in the short to medium term in the underlying business. And then I think that we've already guided that we're going to be adding new locations over the next that's why Steven's here, and that's what we're going to do with the new national bank debt that we have. So I'm not worried about any constraints on growth.
On the growth front, should investors be expecting, would the likelihood of an acquisition be higher or of a greenfield opening of a new location? Or can you comment on where you think the growth path will, in the near term at least, largely come from?
I would say that, one of the things that we've mentioned in the past, it's hard to predict because we have many things that are in discussions and, you never know where these go. But I would say that one thing I would highlight is that one of our most successful, our recent openings was in Red Deer, and that was in partnership with physicians. So I think we are definitely have some partnership discussions with a number of physician groups. And we think that that could be the model you'd see going forward. So that the partnership may or may not be a greenfield, but certainly we'd be investing or co-investing in locations with physician groups, either in our existing markets or in new markets. And I think that'd probably be the most likely. But it's really hard to say. We have new locations that we're looking at acquiring, and we're in those discussions as well. But definitely a lot of discussions with physicians and partnering and building up new locations, helping them expand the success that they've experienced.
Your debt on a debt to EBITDA basis now, as you've been paying down your debt, is very modest. With growth initiatives, let's say there are a lot of growth opportunities ahead of you. What would be the debt ratio that you would be the maximum that you would be comfortable with, or where would you like to see that positioned?
Well, I think if you've seen the companies, that are in the acquisition mode, that you see maybe they go 2 to 3x, then they pay things down, and kind of that's. I don't think we would think about it that much differently. I think that given the recency of some of the challenges that Jeff and I had to take over at the end of 22, I'd say that we'd probably be more conservative in the shorter term. But over longer term, as the business grows, probably that 3x, in an acquisition related transaction, and then with a clear path to paying that down, I think we'd be comfortable. But I think that's more speculative at this point right now. But definitely that gives you a sense. We're probably what if you look at the 2.7 million net debt, we did adjusted EBITDA year to date, or more than that, right? In the first 6 months. So it's really right now we think we have ample opportunity to use our credit lines and cash to do some decent acquisitions here.
All right. And you say acquisitions. How many acquisitions or new sites do you think you could, if there were available just on an operational basis, how many could you do in a year, let's say?
Yeah, again, that's really difficult to say. I've seen single clinics doing 500,000 in revenue. I've seen single clinics doing 12 million in revenue, right? So those are just, I've seen a multi-site network of 3 clinics, 12 million in revenue. So, get you a sense, they can be all over the place. And I think that if you look at even our network, you might have clinics from 2 to 12 million, right, in terms of their revenue. So there's a wide range. And so when I say we're looking at things, it could be anywhere in that spectrum. Something could be smaller that we think we can, step in and grow it quickly. Like it
Yeah.
could be 500,000 revenue, then we see 2 million very quickly. We could have, see something that's, much bigger than that, but, we'd have to, lever up and access capital markets, which right now with the stock where it is, be more challenging.
Yeah. Are you able to comment on acquisition multiples? What is typical in the industry, or maybe for investors to have some kind of expectation on X to X multiple of EBITDA on a clinic, or how are they valued typically?
Sure, yeah, I can take that. So typically we're seeing like on an EBITDA multiple, like it's in the 4 to 5 range. You'll see sometimes up to 6 if it's a strategic site or a strategic market that we want to get into. But that's kind of the broad range for what we're looking at.
All right. Given we discussed that you do have not a lot of debt, very manageable debt, less than EBIT amounts of it, and you have been buying back shares in the marketplace. Can you talk about how aggressively you plan on doing that, and just I guess your preferred use of capital would be in acquisitions, but your capital allocation strategy, and I presume dividends, it's too early for something like that, but discuss those capital allocation strategies and how you're weighing them at this time.
Well, I would say that, first and foremost, from a capital allocation strategy, I think what we've started out first is that if my stock is trading below the market multiple for the deal on my desk, then it makes more sense, I mean, just financially to look at that, and we're financially strong. I think as, although we do have the buyback, you can see that the little over 600,000 that we've done since last November is pretty modest. So, from a dollar point of view, so we're not aggressively in there. We're just consistent. Whether it's management buying or the company buying, it's been pretty consistent over the last recent time periods. And until we get to that point where we're at a point where our stock looks a lot like the things we're looking at in the private market, then that makes more sense. So from a capital allocation strategy, I think we've just decided that with the cash flows that we had, we're more than comfortable to start putting some of that back into share purchases. And we'll evaluate so you can see it hasn't been aggressive to date, I guess, to a long answer to a short question. And as we go into, our 1 year date, which would be November of instituting the buyback, we'll have another meeting with the board, and we'll have a discussion as to whether we should be more aggressive on that. And we're also cognizant, not to, limit liquidity out there. We've trading volumes this year are much higher than last year, so we're very happy that we've been able to buy back a bit of stock and see the volumes pick up. So we're trying not to choke that.
All right. We've covered a lot of territory here. There are no more questions from the audience. I can't think of any things else to ask about. Is there anything else you'd like to highlight or review before we wrap up this call?
No, I think I just want to make sure, I'm very pleased that everyone's, paying attention. We've been doing a lot of things over the last few years, and now you're starting to see that flow through in terms of our numbers, and just, keep an eye on this space where when I say I will not pat myself on the back. We've done a good job turning this around, but until we get to those margins and start executing on some inorganic, the 8 to 10% and the inorganic growth opportunities, that's when we'll start saying, the job well done. So we're doing all the right things, and we'll get to where we need to be over the next 6 to 12 months.
Excellent. Joe, Jeff, Stephen, thank you very much for taking the time to update the shareholders. Much appreciated. Have a great day and talk to you again soon.
Great. Thank you, Martin.
Yeah, thanks everyone.